Hi, how you going here? Once again, it's Rick Newenhoven with another financial tip. Today we're going to be talking about what is LVR. So what is LVR? A lot of you might not even know what LVR stands for. It stands for loan to value ratio. So what that means is what is your loan and what is the value of your house? And if we divide the loan by the value of the house, that gives us a percentage. And then the banks use that percentage to determine what interest rates they're going to lend you finance at. So to give you an example, the key figure with an LVR is generally 80%. If we're less than 80%, we get better interest rates from the bank than if we are over 80%. And then they usually give us higher interest rates. So it's fundamentally important for us, if we want to go for money, to really assess if we're going to be under or over 80%. Sometimes we don't take that into account. The one major differential is that once we go over 80%, most banks will then impose something called mortgage insurance. It's a dreaded word for a lot of people because we don't like additional fees. However, mortgage insurance can be a necessary evil for us, especially if we're a first home buyer. So if we've only got a 5% deposit, that means our LVR is going to be 95%. Therefore, there's going to be mortgage insurance imposed on us for that loan. However, if we choose not to want to incur mortgage insurance, that means we're going to have to save another 15%. So to give you a numerical example again, let's look at a loan of, or a house of $400,000. That means we're going to need a loan of $320,000 to be less than 80% LVR and not incur mortgage insurance. If we have a 5% deposit on a $400,000 house, that is $20,000. So there's a difference of that 15%, which is $60,000. So there's a time cost for us. We have to assess if mortgage insurance is going to cost us, say, $12,000 on a $400,000 house, how much time is it going to take us to save $60,000 to save $12,000? Now, if that's going to be 5 or 10 years, potentially it's most likely worth us paying the mortgage insurance because the capital growth that we are going to miss out on is going to be more than what the mortgage insurance is that we're paying at that point in time. What we want to be careful of, however, is actually paying mortgage insurance repetitively by refinancing every couple of years, because that will eat into our capital growth. So we want to have a consistent strategy that makes sense, which is going to save us money and actually grow our capital wealth going forward into the future. I hope that financial tip on LVR and mortgage insurance has helped, and look forward to speaking to you soon.